Hi everyone, this is Professor Smith, and this short video is designed to help you understand how the Fed's tools of monetary policy are used to create an expansionary or contractionary policy. The first thing to understand, guys, is that the banking system really has three levels. At the bottom, you have customers like you and me who are depositors into the bank, or maybe we take out a loan, like for a home mortgage. Then at level two, you have the banks themselves. And then at level three, on top of the whole system, you have the central bank that regulates the banks, clears the payments, and maintains the bank accounts of the banks themselves. So let's suppose the Fed wanted to put money into the system. Take a look at the channel on the left. In this case, the bank is going to buy a bond held by one of the commercial banks, and in return for that, it's going to pay money for it. Now, here's the key conceptual point. Any money up here at the central bank level is not part of the money supply because it's not in active circulation. The money has to get down into the banking level, out of the central bank. So if the Fed purchases a bond, it will then pay for it with money, putting money into the system. Now take a look at the text down here. That's going to increase the money supply because now there are more reserves in the banking system, level 2 here. Okay, so banks are going to try to lend to each other in what's called the Fed funds market. That's going to lower the Fed funds rate. Now, because it's cheaper for banks to lend to each other, that's going to ultimately lower other rates in the economy, like rates on home mortgages or rates that firms have to pay to a bank to borrow money, for example. That's going to increase investment and also net exports. That's going to increase ag demand, and that's going to lead to higher GDP and employment. Just visualize your right shift of your ag demand curve. But the bad thing is higher prices. Okay, so that's called an open market purchase. It's a subset of open market operations, and that would increase the money supply and stimulate the economy. Now take a look at the channel on the right. Again, where do you want the money to be if you're trying to contract the money supply? You have to take it out of level 2, okay, the banking system. So in this case, the Fed is now going to sell bonds into the banking system from their own portfolio of bonds. They have a huge portfolio of bond holdings. And by selling those bonds, somebody in the banking system is going to pay for those bonds, and that's going to pull money out of level 2. Okay, so that pulls reserves out of circulation in the banking system. Okay, so basically what's going to happen is the exact opposite in the arrows here. That's going to decrease the money supply. It's going to make rates in the interbank lending market higher. That's going to raise rates throughout the economy. That's going to decrease investment in net exports, decrease ag demand, and lead to lower GDP and employment, but it helps fight inflation. And that's actually what our Fed is doing in 2022. That's called an open market sale of bonds, and that's the channel here on the right. And that's a main way for the Fed to decrease the money supply. Now they have two other what we call policy tools that are important to understand. There's something called a repo and a reverse repo. Here's a pretty cool demonstration of that. A repo, a central bank is lending money directly to a bank, and the bank is going to provide some kind of financial security, like a treasury bond, to the central bank as collateral for that loan. Okay, so because now the central bank is lending to commercial banks, those banks in turn have more reserves, and they can then lend out more to borrowers, and that's going to increase the money supply. If the Fed wants to do, or if the central bank wants to do something contractionary, they do the transaction goes in the exact opposite direction, and that's going to pull money out of the banking system. Now, if you ask yourself what the heck is different about a repo and an open market operation, really the main difference is that repos are very short term, like an overnight transaction that would get reversed the very next day. So it's a way for a central bank to, let's call it quick hit. It's quick hitting monetary policy. It's very important today does not get enough description in the textbooks. The third and final kind of what I call the current tools of monetary policy is interest on reserve balances. Now, ever since the 2008-29 crisis, the Fed has been paying interest directly to banks for the reserves that the banks hold. Remember, guys, reserves are funds that are not being lent out by the bank, not being lent out. So the more reserves that a bank holds, the less lending and the less deposit creation, okay, that we learned about in the prior chapter is going to happen. That's going to reduce the money supply if banks hold more reserves. So now suppose the Fed pays a high interest rate on reserves. It makes sense the bank is going to hold more reserves. It's like risk-free money. Okay, but on the other hand, they're not going to lend out as much, and that's going to basically promote a contractionary type of monetary policy. If the Fed wanted banks to lend more, they could reduce the interest rate on those reserve balances, and the banks would say, heck, why are we holding so many reserves? Let's go ahead and try to lend this money. Okay, so higher rates is contractionary, and lower rates, just like usual, is expansionary. Just note to wrap this little video that there are a couple of what I called traditional tools that really are not much used anymore. We learned about the required reserve ratio. So many banks now have excess reserves that the required reserve ratio is basically no longer considered an active tool of monetary policy. And the other one mentioned in the textbook, there's something called the discount window where a bank can go directly to the Fed for a loan. The Fed could use the interest rate on that to discourage banks from borrowing from it. But again, that's a small piece of monetary policy because most banks will go to other banks when they are short on reserves.